In the next 60 seconds, I will explain why stocks are selling off today, specifically small caps and interest rate sensitive areas, as well as cyclicals like the Dow. And there's really three different things that are taking place today. First and foremost, Fed Master says that the markets are correct, or former Fed Master. She doesn't work at the Fed anymore, so she kind of talks more detail perhaps than she used to when she works at the Fed. She basically said today, the markets are correct in expecting less cuts from the Fed in 2025 now that Trump is the president, because basically the economy is going to do better and inflation perhaps could be a little stickier than it would have been before. Now, I don't agree with this logic of thinking whatsoever. Inflation is simply government spending. If we are going to have less government spending, presumably if Elon comes in and starts reducing spending, that is, I mean, that's not inflationary. That's very much deflationary. And I think Wall Street's just wrong about that assessment that Trump is going to create more inflation. Trump could create a better economy, and I agree with that, but I don't agree with the whole narrative of more inflation under a Trump 2.0 presidency. Now, the second reason why markets are selling off today is actually in the form of good news. The October NFIB Small Business Optimism Index is up to 93.7 versus 92, as was the estimate, and 91.5 prior. Outlook still net negative, but at the highest it has seen since November of 2020. Expectations are higher, sales improved. Expectations of higher sales improved, as well as the share of respondents saying now is a good time to expand their business. So if you mix what former Fed President Loretta Mester says, as well as this small business optimism index, it supports the narrative of less cuts in 2025. Now, here's the real kicker. This is what's really affecting markets today. It's the bond market. 10-year Treasury yields are up 12 basis points. Why? Because we have inflation data coming out tomorrow. CPI is expected to come in on the hot side. Last month, we came in at 0.3% month over month for core. You're expecting 0.3% again, so on the hot side. Year over year core is expected at 3.3%, unchanged from last month's 3.3%. Month over month headline inflation is expected at 0.2% month over month, same as we had last month. And year over year inflation is expected at 2.6%. Last month we were at 2.4%. So across the board, you're expecting somewhat hot inflation numbers for tomorrow. Now, given the markets have rallied so much in recent weeks, it's not surprising that you're seeing a give back in those areas of the markets that have rallied the most. Now, big tech is selling off today as well a little bit, not nearly as much as other areas. Meta's down 1/3%, Apple's up 0.1%, and actually they've all now went green again. At some points throughout the trading day today, they were actually in the red, but they have since went green. Kind of a flight to safety in big tech, if you will. But if you look at the RSP, for an example, the RSP is down 0.82%, and the headline S&P is down 0.36%. So equal weight S&P is almost 3x underperforming the market cap weighted S&P. That's because there's fears of maybe inflation's going to come in hotter than expected. We normally get this every CPI report, but this time, following a rally that we have seen in the equal weight S&P in small caps over the last 2 weeks or so, ever since the election, it's just holding a little bit more weight. It's just a bigger catalyst this time around, and it's having a more negative impact on markets. Now, the good news here is, if we do get hotter than expected CPI, you've already priced in a lot of that today. You've already priced in a lot of that downside today. So perhaps it won't be as bad coming tomorrow. And the other positive is, if inflation meets expectations, you may actually rally on that because you've already priced in seemingly bad news. Now, here's the really good part of today, though. Like the the gold for the bulls, if you will, for the day. The VIX is actually down today, down 1/3 of 1%. The Russell is down 1.76%, huge down day for the Russell. The NASDAQ is down 0.2%. The S&P is down 1/3 of 1%, and the Dow is down 0.57%. So why is the VIX down as well? That's not what normally happens. Normally, heading into a CPI report that is as important as this one is, and when you see risk on assets selling off, even Bitcoin selling off a bit today, but the Russell and economically sensitive indexes like the Dow selling off, you would tend to see the VIX up anywhere from 3 to 7% on a day like today. Again, especially because we have that CPI report tomorrow. That is not happening. So why is that good news? Because the VIX not rallying today tells you that Wall Street is really not that nervous right now. This is not a, sell everything, buy hedges kind of moment. This is not even a buy hedges kind of moment. The VIX is red today. That means there's more calls being bought on the S&P than puts. To kind of put it simply, there's other things that go into the VIX as well. But that means there's more people looking at upside positioning here, more people that are bullish on markets than are bearish on markets. And that does not normally happen on a day where the Russell is down about 2%. So I take this as a really good sign that markets are not done going higher. And let me tell you, I would not be surprised if markets rally coming tomorrow. I think the VIX is kind of snitching to us. This is not as bad as we think. This is certainly not the start of a correction, at least from what the VIX is telling us. With that said, we still do have some bigger earnings for this week, including Walt Disney and Cisco and Alibaba, Applied Materials, and some others. But today in after hours, we have SoundHound, Marathon Digital, Kava, Spotify, Oxy, BioStem, Rocket Mortgage, TerraWolf, and Instacart. None of these companies this week are really going to be needle moving for the markets. You've already gotten the vast majority of S&P 500 companies that have reported earnings, so we have a pretty good idea of this earnings season, and it's come in good so far. So I don't think any of these companies are going to be massive headwinds for markets or massive tailwinds for that matter. But they are still important to pay attention to. What's also fascinating today is the CNN Fear and Greed Index. Yesterday, you were at 67, so definitely on the solid side of greed. Today, you're at 68. So that means you are a little bit more greedy today than you were yesterday in markets. But again, the Russell's down 2%. All of your major indexes are in the red today. That means that someone out there somewhere is very much not concerned about what we're seeing today and bullish on our markets, because something is going on here that is strange. On such a red day like today, you would expect to see the CNN Fear and Greed Index plummeting. You would expect to see the VIX skyrocketing, and that is simply not happening. In other words, Wall Street is not that nervous about the data coming out tomorrow, about this sell-off that we're seeing today in markets. They're just not that concerned. They're not that worried. They're not that fearful. Now, the percent of stocks trading above their 50-day moving average fell today to 63.22%, down about 4.5% today. So definitely more of a risk-off move in equities, but I think it's more healthy than anything. Given the rally that we've seen recently and just how aggressive it was, we should expect a consolidation period at some point. And I think that's exactly what we are getting right now. So no, I don't think this is the start of a correction. I think this is actually very normal and healthy to see a bit of a reset to the downside, a bit of a consolidation, if you will. Sentiment today is bearish at 38. Yesterday, it was bearish at 40. So really not that bad relative to just how red things seem to be today. Message volume is coming in at 49, which is normal. That is higher than what you've seen yesterday when you were at 46, so that's good. Participation ratio today is at 54, which is considered normal. Take a listen to this clip on CNBC that says, we're bullish on U.S. equities. American exceptionalism on steroids.
So, Janet, we're coming off, another record-breaking day on Wall Street. We're seeing bond yields. They've ticked up a bit since they were higher than they were pre-election, but they've cooled off from the highs that we saw. We're looking at the equity market. Where would you put money to work right now? Where are you seeing opportunities?
Yeah, we're bullish on the U.S. equities. We have recently further raised overweight in U.S. equities because primarily a Trump victory means American exceptionalism on steroids. And we think that the pro-growth measures like tax cuts and deregulation are particularly supportive. So in terms of where we are taking the money from is basically Europe ex-UK equities, because I think Europe is fighting two trade wars potentially against the US and one with China. So I think the economic momentum is already not that great, and I think the downside risk materially increased under Trump presidency.
Okay. I do want to talk to you. So you're saying you think the market, well, I can't disagree with you. The market seems to like the proposals that Trump has put forward so far overall, but there's one tariffs that seems to kind of raise a lot of questions. I just want to read to you what Goldman said about tariffs very quickly. On tariffs, they said they could potentially reduce earnings via weaker consumer spending, regulatory tariffs, U.S. exports, and increased uncertainty. And then they go on to say each 5 percentage point increase in the effective U.S. tariff rate would likely reduce S&P 500 EPS by about 1 to 2%. So I know you're saying that a lot of those Trump proposals, at least, and possible policies, the market seems to like them. But what about this tariff risk when it comes to earnings?
Yes, I mean, it really depends on to what extent these tariffs are being enacted. We still don't know the likely timeline and the quantum and implementation. So I think there's a lot of uncertainty, which, of course, this is a risk that we have to keep an eye on. And I think all else equal, tariffs will be negative on corporate earnings, particularly to those that are highly exposed to trade in China. But overall speaking, I think, well, given the fact that the U.S. economy is, at the moment, very resilient, and I think particularly rate cuts are still on the agenda, that is likely to support valuations, at least in the next 12 months or so. So overall speaking, we think that the positive outweigh the negative.
You mentioned those Fed rate cuts. I do want to talk to you. President-elect Trump has spoken very much about, just kind of his questioning of the decisions that Fed Chair Jay Powell has made and the Fed has made. As an investor, how do you look at just this, risk, I guess, when it comes to the president-elect and the Fed and the idea that he might try to institute what some people are calling a shadow Fed chair or something like that?
Well, I'm not too particularly worried about that risk, given I think Jay Powell already said he's not going to resign, and the legality of that actually keeps the Fed pretty much independent from the government. And I think if there's any sign of any risk of that, I think the market would have protested, and that would have a detrimental impact. And I think it's very unlikely that this would actually happen. So I very much believe in the independence of the Fed. Yeah.
Okay, so you see low risk there. Before we let you go, got to ask you about Bitcoin. It's surging to new records. How do you view Bitcoin, especially when you're talking about portfolio management?
Well, it is the digital gold, right? I think it is a form of diversification for investors. And I think in the view of higher budget deficit and higher debt issuance, I think I can see the point of people getting into cryptocurrency because it is a store of value. I mean, I think the volatility itself is huge, so it may not be appropriate for all of the clients out there. So I think you have to be very selective. I think that there's certainly a case for those who are more pro-risk, but certainly not for everybody.
Very quickly, we got to go, Janet. Would you buy an ETF or would you buy Bitcoin directly?
I personally would buy Bitcoin directly. Yeah.
Okay.
I would like to hold the physical asset.
Now, with that said, I just want to wrap this up with my thoughts. As I've said before, we're kind of in a sweet spot for markets where markets are likely to push higher into year end. Today is a bit of a consolidation day. They can last a little while, okay? You can see 2 or 3 of these in a row. You could see tomorrow's a big green day. The next day is a big red day. I think we're in a bit of a consolidation phase right now, right below 600 on the SPY. Once we break above 600, that's where you get into a larger rally, potentially that sends us as high as about 620 to maybe even 630 before you see another round of consolidation. Now, at some point, I expect a correction will occur in early to really mid 2025. Around growth concerns, I think we've come to the conclusion that we're going to have a soft landing, but that is not a guarantee at this stage. That's just everyone's opinion, but it's not a guarantee. So, do I think this is the start of a correction now? I do not. I think if you want to take advantage of buying opportunities, if some stocks fall more than they probably should, that is likely a buying opportunity. But there's nothing wrong with just sitting on the sidelines here, waiting for the best possible opportunity as well. Just sitting here doesn't look like a terrible idea. Let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.